People say a lot that culture defines a company, but one of the things that I think helps to define culture is business model. And our business model was always built with the idea of building an automated financial solution. If an engineer wastes 4 hours doing some manual task, they not only have permission, but there's the expectation that they spend at least 4 hours automating that task for the future. We do a customer development process where we explain a product that we're considering building to clients. We might show them a visual mock-up or a demo of the product. And what we're looking for is a level of excitement where they're sort of reaching across the table to try to grab the product from us. If you look at our financials, we look like a SaaS company.
Hello everyone, welcome to FinTech Leaders, coming to you from New York City. I'm your host, Miguel Armaza. I'm a co-founder of Gilgamesh Ventures, a venture capital fund that backs early-stage FinTech entrepreneurs. If you enjoyed this conversation, I invite you to leave a review on Apple or Spotify so more people can learn about FinTech leaders. In this episode, I traveled to San Francisco for an in-person interview with David Fortunato, CEO of Wealthfront, an asset management giant with over $70 billion in assets under management and over 1 million clients. Founded by Andy Rachleff almost 15 years ago, Wealthfront is now one of the most defining financial brands for millennials and Gen Zers. David joined the company in 2009 as a junior software engineer and became CEO almost 4 years ago. Full disclosure, I enjoyed getting to know the team so much that I opened my Wealthfront account as I was leaving their office. In this episode, we discussed building a culture of engineers and automation, product expansion strategies, a sustainable business model that looks a lot more like SaaS and not a financial institution, buy, build, or partner, and what it takes to successfully build most of your tech in-house, and a lot more.
David, thanks for opening your doors to the Wealthfront mothership, although I know this is the smaller office in SF. Excited to do this. I want to ask you right off the bat, in preparation for this interview, I had a chance to talk to Andy Rachleff, just a phenomenal guy. And he mentioned that when you first joined the company, you were the most annoying engineer in the room because you would poke holes into just a bunch of the decisions and you would question everything. And eventually he got tired of it. So he made you CTO. Like a year in, you were, 24, 25. Take us to the time where you were not CTO, you were sitting in the room and just questioning everything. Why were you doing this? Well, first, thanks for having me. So I think Andy lays on a little bit of extra mustard in the story, which is fine. But after he retired from Benchmark, he was mostly been teaching at Stanford Business School. And he likes that dynamic of folks pushing and asking questions. And so I think much more than other folks who might be early stage startup CEOs, he was very interested and enjoyed those type of conversations, those what if questions. And I think that defined a lot of our early culture, and what's maintained kind of in our culture to date is a desire to ask questions, push leadership, really make sure that we're getting to the best answer that we possibly can. And I think that came originally from Andy's experience working at Stanford and wanting his students to do the work, ask questions in class, push him on sort of what the right answer was and make sure they really understood. And Andy and really all of the leaders that we've had over the years have really been interested in making sure that all of our employees have the right context and the right understanding of what's going on in the business. And so they like being pushed, and I like being pushed to make sure we get to the best answer.
So you felt that you had permission to do that? But I'm sure even in an environment where you have the permission, not everyone is really doing it, right?
I think it's
Could
true.
be outside or inside Wealthfront, right? Well, so what drove you to just question everything?
I mean, I think a lot of it was my educational background and sort of, I went to Amherst College, which has very small class sizes and an expectation of engagement in class. So I think the largest computer science class that I took junior or senior year was 4 students in the class. And so it was most classes we were getting up on the whiteboard and explaining things to both the professor and the other students. It was a very interactive and engaged process. And a bunch of classes did only oral exams where you had to explain concepts in the professor's office. And that sort of set the expectation that being able to talk about ideas, whether they're technical or business related, is incredibly important to actually being able to deliver on those ideas. And so I think that my educational background fit well with the culture that the company had in the early days, and I think still has today.
So one day you get promoted to CTO. It's a very different experience from being an individual contributor, engineer, to CTO. What was important? What did you realize was important as CTO?
Yeah, so we were still a very small company, and all startup roles are really a combination of opportunity and necessity. And so if you're 10 people, we were 10 people in a converted dry cleaner in Palo Alto. It was not the most luxurious office space in the world. But so there was an opportunity because we needed technical leadership, and it was helpful to have someone play that role. But also most of the folks at the company were some of my closest friends. We spent a lot of time together. We knew each other well, and there was a need for this role. And it's more than it was really, I think, a massive shift in my responsibilities. I think Andy solidified some of sort of what I had taken on over the previous year. And in terms of my role on the engineering team and with peers, I don't think much changed because we still engaged in discussions. We still had lots of talk about what the best architecture was, what our priorities should be, how we should think about delivering a solution to a problem. We built out a lot of our trading infrastructure, reconciliation infrastructure, data infrastructure in those first couple of years, some of which is still in use today, some of which we've kind of outgrown in the last 12 or so years. But I didn't see it as, it was definitely a promotion and title change, but really what I saw it as was an encouragement to keep doing what I was doing and to continue to build on it. And I think one of the things that the easiest folks to promote to new roles are folks who are sort of doing some of that role today. And you want to give folks the permission to do it where they feel comfortable taking on more responsibility. But we really want to promote and encourage leaders rather than managers. And leaders are going to find ways to fill gaps whenever they exist.
I think we talked maybe last week or 2 weeks ago, and you mentioned that still to this day, 50% of the company are software engineers, including the management layer, right? So technology, engineering, super important at Wealthfront. How does this define the company?
Yeah, I mean, so from the very early days, we wanted to approach most of the problems that we had as technical problems, and we wanted to find technical solutions to it. A lot of that was influenced by the type of business that we wanted to build. And so one of the things, people say a lot that culture defines a company, but one of the things that I think helps to define culture is business model. And our business model was always built with the idea of building an automated financial solution. And so what we really saw, I think, was the company has always been 50% engineers. It's not like that was, it became a conscious choice to keep it that way over time and important to us. But it was really what was necessary to build the company and the company that we wanted to build and to make the business model that we wanted to work. I think that we have continued to do it is because of the results that we've been able to achieve because of it. So we're the low-cost producer in the space. And it's little things like instilling in our engineering culture a concept of proportional investment. So if an engineer wastes 4 hours doing some manual task, they not only have permission, but there's the expectation that they spend at least 4 hours automating that task for the future. And we've changed the multiple depending on how fast we're scaling. So if we're signing up a lot of clients, you actually should spend 2 or 3x the amount of time that you wasted because if you're growing clients at a significant rate year over year, that 4 hours that you wasted today might end up being 8 hours in a few months. And so getting ahead of that investment is very important. And the continued investment over 10, 15 years in building and improving technical infrastructure has led to us having very low costs to operate the business, which also means we can spend a lot of time focused on the best client experience that we can deliver and building new products and features and getting them to market quickly in an automated way. So in the early days, we didn't have a designer in-house. And I think that the early design hires that we made were also vitally important to the company that we are today, because we become known as a very simple and easy to use solution. And I don't think that we would have gotten there without recognizing relatively early the importance of good design work in what we build and ship.
Here you mentioned the efficiency that has become more evident as you grow your AUM, which today, correct me if I'm wrong, but is around 70 billion. Is that right?
Yeah, I think we just passed 75.
75.
Today.
Okay. I am 1 month behind the data. So 75, what does that mean in terms of revenue per employee?
Yeah, so we're well over on a run rate basis, we're well over $1 million of annual revenue per employee. And we've continued to hire quickly. So it's not because we're not hiring, we're hiring folks. But I think really that's a focus on the automation that we built, the focus on continuing to improve the product, continuing to make it simpler and easier to use, and then if something causes problems for clients, we want to hear about it very quickly. We want to prioritize fixes to those things and get them into the product so that those problems don't emerge in the future. I think a lot of companies look at client contact as a cost. We look at it as an input to our roadmap that helps us prioritize to deliver better for our clients and be more efficient. So every time we get a client contact, something is not as it should. And we think of how can we make this experience better for clients so that there is no need for them to contact us and they can resolve this the same at noon as they can at midnight.
Now, I'm sure out of the 75 billion, you have a mix of clients actively invested, you have a mix of deposits, right? As interest rates start to go down, and now they actually are going down, we had a good old Jerome announced 50 basis point cut yesterday or 2 days. You lived through the ZIRP era, now you live to high interest era. What happens from now on?
So we've been through a couple versions of this. And so the most recent one before this rate cut cycle was 2019. And we had our cash product and our investment product live in 2019. We grew cash assets from, I think it was, 6 to 9 month period from the 3 rate cuts and then the 2 emergency rate cuts that happened around the COVID era. And I think the 2 emergency cuts happened about a week apart. The day before the first of the normal 25 basis point cuts that happened in 2019 to the day before the first of the emergency COVID rate cuts in 2020, we actually grew client assets by 50% in a declining rate environment. And so I think a lot of people think about the products that we have as the absolute rate that we're able to pay because we're willing to share more with clients than competitors are, because we're the low-cost producer in the space, which means we can afford to share more with clients. But at least as important is the competitive dynamics and what our rate is relative to peers. And because we are the low-cost producer, it allows us to share more with clients if the effective Fed funds rate is 5.25, or if it's 4.5, or if it's 3, or if it's 2.5, we're able to share more with clients than competitors are.
Let's talk a bit about kind of the culture that you have at Wealthfront, which is of building a lot internally, right? Even to the point, I was surprised to hear this from Andy, that a few years ago, you actually decided to build your own clearing system, which was not easy. It took about 2 years, kind of stopped the development of other products or projects, I'm sure, right? But what kind of impact does that have, like building your own stuff internally and not necessarily partnering for everything?
Yeah, so I wrote the board memo at the beginning of that process to explain why we were going to undertake this huge effort. And ultimately, it boiled down to three reasons, which I think that type of infrastructure investments and other infrastructure investments that we've made over the years that are similar in scope and scale to that one have proved true, which is we're able to deliver a much better client experience if we control more of the client experience. Then we can build more automation in, and we can make sure that the products that we deliver are sort of meeting client expectations. So previously, as an example, the client statements that we generated were from an old COBOL-based system at a vendor that we used. There were a bunch of things that were wrong with that. For example, it was very difficult and very costly to generate not end of month statements, but a snapshot statement, which is folks ask for if you're getting a mortgage. And there's a variety of other cases where it can be useful to have a statement for the middle of the month where you want to send something current and up to date to someone who's making a loan, for example. That was a multiple email process back and forth with a vendor to be able to get that statement for the client. It takes a lot of time, effort, energy, and is prone to error. Now, if a client wants a statement, we can generate one on the fly because we control the statement generation flow, and we can get them the statement in a few seconds in the same web session or mobile app session that they're using. So it's a much better client experience because we're able to drive more automation and more speed in what we deliver to clients. The second thing is we're able to launch new products and features which are much more difficult to do on other folks' infrastructure. So we have a lending product, let's take margin loans, called Portfolio Line of Credit. So if you need liquidity to pay a tax bill or because you have some expense that unexpectedly came up, you can take a Portfolio Line of Credit withdrawal, and we're charging somewhere around 6.5% today. So it's a very competitive rate with other loan products, and we can get you the money the next day. That offering was only possible because of the investment we did in our infrastructure to enable it. And then the third thing, which is really a benefit for Wealthfront, is we're able to keep costs low because we take on more of this responsibility. We've turned a variable cost into a fixed cost. As we scale, it means that the incremental cost of that investment goes down and down on a marginal basis, which means we can invest the revenue or profit we're making from growth in new products, or we can share it with clients, and clients can get more as a result of it.
Also, this becomes your moat, right? Because it's harder for competitors that are using vendors to kind of match that. But I guess you can only achieve that if you have a strong engineering culture like you do. Where do you draw the line? How do you know where to partner and when to build? It's always the age-old question.
Yeah, I mean, there's a lot of cases where to get something launched quickly, we'll partner, and then we'll learn a lot in the process of getting a product live. And I think that learning is invaluable. We're not just trying to learn sort of what the client behavior is, although that's a very valuable thing to learn as well. We're also learning about what are the issues with operating this product? Can we do a better job, or can we not do a better job? And so some vendors we work with today, we're very happy with because they do a great job and they have our ability to improve on the experience that they deliver is there's not much we can improve. But in cases where we can make significant improvements, where we can deliver a better client experience, like ultimately we're going to want to deliver the best client experience that we can. And so we would take on more responsibility there.
Speaking of clients, are millennials your biggest customer segment, or how about Gen Z? Maybe tell us a little bit about the customer base.
Yeah, so I mean, millennials are the biggest generation in the US today, and they make up most of our clients. We do have, I think, a surprisingly high percentage of Gen Z clients, younger clients. And I think part of the reason is because it's really easy to get started with a small amount of money on Wealthfront. We don't charge monthly fees, which when you're at lower, offer the same rate to any asset level. And so I think the Wealthfront offering is a great product at lower asset levels. And for folks who want to save and invest for the long term, they can do that on Wealthfront if they have $100, $500, or $100,000 or $1 million.
What have you learned about serving millennials, right? Is it Is our generation, I mean, as a proud millennial, is our generation fundamentally different than boomers or Gen Xers? Or is it very similar, just a little bit more tech savvy?
I think there definitely is a different expectation in terms of how the product is delivered. So in general, our clients don't really want to talk to us ever. And they view having to talk to us as something has gone wrong, because it should be more efficient and effective to do it on your mobile phone or on a website. You should be able to take care of it any time of day. And there should be an automated flow that enables you to do that. And I think that's true of sort of the digitally native generations, which I would include millennials and Gen Z, where folks don't want to have to go to an office to talk to a financial advisor. They don't want to have to take time out of their day that they could be working or doing whatever else they want to do with their lives to drive somewhere to see someone in person. They would rather just be able to take care of it and be done with it. And I think that we built a product originally that was the product that we wanted to use. So 2009, 2010, I was 22, 23, and the financial advisors that were available then were you had to drive to some strip mall and walk into the guy's office, and he would type some stuff into a computer, and then he would print out a report that he would give to you, and you'd take a look at it, and then he would help you with whatever investing that you wanted to do. That was an incredibly painful process for, I think, digitally native folks that were used to more automated solutions. And so we built the product that we would want to use instead.
How would you describe yourself as an investor?
Yeah, I mean, I use Wealthfront, and I haven't bought an individual stock since college.
Fully diversified.
Yeah, I mean, there are things that I'm good at, and I think it's very difficult to outperform the market, or impossible to outperform the market over long enough periods of time. And certainly the effort that I would need to put into that would be at least a full-time job if I was trying to do that. And ultimately, what I would rather do is to build a great solution that's going to deliver market returns at low cost to as many clients as I possibly can.
You offer quite a few products within the platform. You obviously started with one, and then you've expanded. How do you inform the company when it comes to this product expansion?
Yeah, so one of the things that's been interesting is the period that we launched our initial investment product to about 2018 was a pretty amazing period to build a low-cost diversified investment solution. The market generally was up over that period, but there was a ton of volatility associated with European debt crises, issues, sovereign default or near sovereign default issues in the US with the debt ceiling crises that seem to happen every year. It made it difficult just to pick stocks and have them go up. And so we focused on our investment offering for most of that period, and I think built out additional tax features, built out additional scale, launched a financial planning solution, which our clients are big fans of. In 2018, we realized that through business cycles, we were going to need to offer a diverse set of products to be able to continue to attract and engage clients as the business cycle changed. And that led us to work on our cash product, which launched in 2019, I think on Valentine's Day. We saw a lot of success with that product. And then since then, we've been sort of looking at the risk return spectrum of what we offer to clients and making sure that we're filling in places that we have less direct offerings. So since then, we've launched our stock investing product, which encourages clients to invest, if they are going to invest in individual stocks, to do so in a way where they can diversify across individual stocks. We've launched our automated bond ladder product, which automatically buys bonds and rolls them for clients as they mature. They can obviously control the duration of that ladder, and they can make changes like if they would like it to end on a given date. And we're going to continue looking at additional kind of investment offerings that we can have on the risk return spectrum to make sure that we have offerings that meet clients sort of at the level of risk and return that they're looking for.
And you personally, how do you lead the decision-making of what to develop, right? Because obviously you have options. Your team comes to you with 3 possibilities. You only can decide on 1, maybe 2. How do you have a decision-making framework when it comes to product development?
Yeah, so we've always looked for we've looked to ship products that our clients, when we do a customer development process where we sort of explain a product that we're considering building to clients, we might show them a visual mock-up or a demo of the product. And what we're looking for is a level of excitement where they're sort of reaching across the table to try to grab the product from us. So we might show a new product to clients and say, is this something you might be interested in? And if they're like, yeah, I could be interested in it, that's a no. We're not going to count that as something that they're interested in. If they're like, when is this available? I would really like this. Can I get this right now? How much money can I put in this right now? Then that's a yes. If they're asking us more specifics that's going to lead them to want to use the product, that's something we would consider a yes. And so really what we're looking for, we don't have a sales team. We spend much less on marketing budgets than I think other fintech companies do. We really want products that clients understand from our marketing materials and are reaching across the table to get from us. And so when we do our customer development process, we're looking for that level of resonance with the product.
You're looking for that product market fit before you even launch it.
Yeah, I mean, it all goes back to the Steve Blank 4 Steps to the Epiphany and Eric Ries's Lean Startup. All of those methodologies informed how we thought about things from the early days and have informed our product process.
One thing that comes up in this conversation, and I know that you guys are proud of this, is you really do emphasize on the tech of fintech. You're more of a individual or consumer SaaS product more than financial services product. Is that how you think about it?
Well, certainly if you look at our financials, we look like a SaaS company, and many fintechs are transactional companies. And so they're monetizing based on transactions. And so they need some level of activity to continue monetizing effectively. In our case, we're charging a fee based on assets for almost all of our products. And so the way that we monetize is by continuing to manage client assets. And we have aligned incentives. If we're effective at growing our clients' assets, then we make more money in the future. So when you look at our financials, ultimately, we're getting paid some amount today. We can predict if those assets stay at Wealthfront, they don't grow and they don't fall, we're going to make the same amount of money next month, next quarter, next year. And our goal is to be able to stay ahead of the product offerings, continue to do more products and improve the existing product experience so clients want to continue using Wealthfront. And ultimately, because most of our clients are millennials and Gen Z, they're in the wealth accumulation phase of their lives. We want to attract, as they earn money, we want to manage more of their money for them. And whether that's through a direct deposit or recurring deposit or one-time deposits, we want to win more business from them because we're delivering the best experience that they can get in the market today. And what that leads to is very high retention, very low churn, very long client, and a relatively predictable revenue stream from clients, which looks a lot like the way that enterprise SaaS companies' financials look.
If you do things right, the lifetime value of the customer or the lifetime of the customer is their whole life. You want to serve them post-retirement.
Yeah, so we don't actually use client lifetime value as a metric that we track because it ends up being dominated by whatever discount rate you use. Mostly what we're focused on is continuing to grow our relationship, deepen and broaden our relationship with our existing clients. And when we look at our sort of the effectiveness of our marketing, we're looking at payback periods rather than client lifetime value because clients stay with Wealthfront for so long that we can't just optimize for paying any cost. We've been fairly frugal with how we think about marketing because we would rather spend our time building products. And so using our capital to improve our infrastructure, improve our product offering.
Speaking of your customers, something, I don't know if you think about this at all or not, maybe about a month ago, now there is a report that the legalization of sports gambling and a bunch of other gambling avenues is actually hurting the investment budgets, right? And I forget the number, but it's a significant portion of your budget that would be going to portfolio investing is actually going to gambling and not being compounded for the future. Is that something you think about at all?
So I would say it's going to it's a good that's trading off with trading budgets rather than investing budgets. I think that what we're focused on is helping clients build wealth for the long term. It's a very low dopamine way to build wealth. And I think one of the things that a reporter told us in the early days is you're basically a more attractive way to eat your broccoli. We're trying to help people do the right thing. It's not the most exciting way to trade, but ultimately it's the one that's going to lead to the best outcomes based on academic research. And so I would not encourage our clients to think of sports gambling as a way to build wealth. I would also not encourage them to think of day trading as a way to build wealth, which doesn't mean that if folks get enjoyment, they can think about day trading or sports gambling as an entertainment budget. This is something that Burt Malkiel likes to say is he enjoys going to the racetrack and betting on horses. And he does it with a very small percentage of his income. But it's something that he's enjoyed since he was a kid, is to go watch horses at the racetrack. And as he got older, he liked placing some bets on the horses and who was going to win. But he's doing it with 1 or 2% of his income, not 50% of his income. And so I think if folks think about sports gambling or if they think about trading as entertainment, that's fine. People can spend whatever money they would like to on entertainment. I would just encourage them to limit that to an amount that they're comfortable losing.
Fair enough. In thinking going forward, and this is a little bit related to that product question, but how are you balancing kind of today's decisions versus the decisions that are going to impact the company in 5 or 10 years? Because you got to keep an eye on both the immediate short term and the long term.
Yeah, we've always thought about sort of trade-offs between incremental optimization in our product offering and more exploration. And so at any given time, we want to be working on some number of exploration initiatives, but we also need to make sure that we're working on some incremental improvement or incremental optimization products. And so we look at it and we think about it a lot like a portfolio point of view. We want to make sure that we're spending at least 40% on exploration and at least 40% on incremental improvement and optimization. And the exact percentage will shift around a little bit depending on what we see, what we hear from clients, also how fast we're scaling, right? If you're signing up a lot of clients quickly, then you're probably going to have to spend more time on the incremental improvement and optimization than you would in a world where you can do more exploration when things are less crazy with your operations. And so we're spending a lot of time now, for example, on making sure that we call it product support or client support function, have the tools that they need to be able to help clients, that we're categorizing any requests from clients that come in and addressing them quickly. And so we're probably spending more than 40% today on the incremental optimization and improvements because of the rate that we're signing up new clients. And there are periods where we spend much more than 40% on exploration and building new products. It's all going to depend on the specific context and sort of how we evaluate both where we've been and what we've invested in the past and what we expect to invest in, want to invest in the future.
Is that reflected in your day-to-day? Like, do you have a typical day? What does your day-to-day look like?
Yeah, I mean, I spend a lot of time with the product roadmap teams, the folks who are working on the products and the executives who work on the product roadmap. I spend a fair amount of time with legal and partnerships as we are kind of working on expanding our partnership opportunities and making sure that we're making decisions that serve in the best interest of the company. But I would say in general, most of what I see my job as being is to find ways to make sure that our executives, leaders at the company have the tools that they need, have the folks that they need to be able to be successful, and to make sure that there's a shared set of context among the product teams that are working on what we're building so that they're able to move in harmony. And if anything comes up that's in the way of that, then to resolve it quickly so that we're able to get back to working on whatever is most important. And so I think we've been doing this, I guess, for 14 or 15 years, or I've been at the company for 14 or 15 years now. We have over 1 million clients today. We have 75 billion in assets. I think the folks that we have are incredibly talented and skilled at what they do. And I want to make sure that we're creating an environment that allows them to work most effectively to get things done for our clients.
How about the next 15 years? If we talk, hopefully we'll talk sooner, but if we talk in 15 years, where's Wealthfront?
Yeah, so the most interesting thing I think that's happened in 15, we started building a product for 22, 23-year-old software engineers because we were 22 and 23-year-old software engineers. And that's what we knew. And the thing that's happened in the last 14 or 15 years is we've gotten 14 or 15 years older and our lives have gotten more complicated. So might have gotten married, might have had kids, bought a home, saving for college if you have kids, and not at retirement age yet, but thinking about what that might look like and when that might happen. So what's going to happen in another 15 years is folks are going to be 50 years older. And really what we want to do is continue supporting the financial ambitions and helping digital natives save and invest for the long term. Now, their needs are going to be very different in 15 years from today. Like they are different today than they were 15 years ago. And so continuing to build for that audience and deliver what they need before they need it is our kind of core focus. And this strategy isn't new. I think Schwab did a great job of executing this strategy to help the baby boomers. They came out with technical innovation, being able to trade over the phone. They came out with price innovation. They charged a much lower fee than the traditional wirehouse brokerages did at the time. And they continued to expand their product offering, their advice solutions, their asset management products as the baby boomers got older, and they continued to meet their needs throughout their life cycle. And what we're trying to do is to do a very similar thing for a younger audience.
David, I hear you are an avid reader. You love to read. How many books do you think you're reading a year?
Well, I'm reading a lot of books a year. I would say that I also I'm an avid discarder of books.
So you're not finishing all.
No, I don't think it's important to finish and read every page of a book that you get. I think it's much more important to get whatever value you can get out of a book. And so I like to get books on a bunch of different topics. And I will finish a bunch of books, but I would say that my goal is not to finish every book that I pick up. It's to learn whatever I can from it.
Any one or two books that you find yourself recommending often?
Yeah, I'd say sort of two books. One that I think is sort of evergreen and I really enjoyed. It's called The Finite and Infinite Games, which I think was written by a professor of religion in the 80s. And it talks about sports were kind of more structured games or really finite games. And the goal is to win. And then there is an infinite game of life where the goal is not to win. The goal is to keep playing. And you want to bring as many people into it. It's not a zero-sum game. And so it's sort of, I think both is a warning and a guidebook to not thinking about life as a game where the goal is to win, but thinking about it as a positive sum game where you're trying to both get the most out of it yourself, but the way you get the most out of it is by helping other people get more out of it as well. So I definitely recommend that. And then one that I read recently that I thought was very interesting, it's called The Price of Time, which is, I think, a story about the history of interest and the role that interest plays. And I really enjoyed that book as well.
I've been reading that one. I tend to read many books at the same time. This one is taking me a while. It's a thick book, but super interesting. I agree. Well, David, thanks again. This has been amazing. I really admire you, the company, Andy. So it's been a joy getting to know you guys. And I hope this interview is just as inspiring as it has been for me, for the rest of the audience. I'm sure it will.
Thanks so much. Really appreciate it.
Thanks.
Thanks for tuning in. I hope you enjoyed this great episode with David Fortunato from Wealthfront. If you want more interviews, make sure to subscribe, follow, and leave a review on Apple Podcasts, Spotify, or wherever you get your shows. It helps and means a lot. And if you have any suggestions or thoughts about the show, just drop me a line on Twitter or LinkedIn. Signing off till next week, I'm your host, Miguel Armaza. The FinTech Leaders podcast is for informational purposes only and should not be considered financial or investment advice.